Welcome to this edition of Diligence Inside America's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. Today, we're going to have a discussion about incorporating ESG goals into executive compensation. And joining me is Jim Heim, who's a partner with Meridian Compensation Partners. Welcome, Jim.
Thanks for having me, TK.
So, obviously, ESG is not something that has just popped up. We've been hearing about it for some time, but I think the COVID-19 and the social unrest certainly has pushed ESG to the front. And now we're seeing investors and proxy advisors certainly pushing to have added disclosures and, more importantly, make elements of ESG and stakeholders actually key performance indicators and also try and put targets and goals into executive compensation. So, that's what we want to sort of discuss today. And it is something that we've seen a company recently, a respected company, set up some goals in their executive compensation for diversity. Now, no surprise to people that follow the business world, Starbucks had some challenges with diversity and felt that this was a good demonstration of their commitment to make sure that they correct the problem. But Jim, whenever I see something like this, where a respected company, makes a sort of a move to incorporate something into their more formal plans or their executive comp, so it's measured, investors and proxy advisors like to point to that company and say they can do it. Why can't you? So I'm suspecting that there certainly is some discussions going on in the boardroom. And with all your compensation committees that you've been a part of recently, what type of ESG discussions are comp committees having? And would you say that the current environment, as far as companies incorporating ESG goals and targets into executive plans, is sort of we can expect more to happen?
Oh, I absolutely think we can and we should, and I think there's a lot of truth to what you say about whenever there's one of these bellwether companies that comes out with some new measures. It absolutely perks up the ears of other board members as well as the broader investor community. I think it's useful to just sort of remember what we're talking about with ESG. It's environmental, social, and governance measures. But by and large, what I would suggest companies are really being driven to is to think about that as measures that help them with sustainability. Ultimately, they're looking at these as measures that get to their long-term ability to function as a business. And I think they're looking at it more as a case of company value as opposed to values. That's definitely the way some of the large investor groups, whether it be BlackRock or Vanguard or State Street, are looking at this. The discussions that I'm seeing in boardrooms, well, there is a lot of variation right now, TK, in terms of type of company and what sector they're in, the size of the company. And I think by and large, there's kind of two things worth talking about. One is processes that are being looked at for considering should we put a measure in, and then there's the results. In terms of the process, way a lot of these companies look at it is they start out by trying to understand the perspective of their investors on these ESG issues and just sort of documenting what's out there in the broader environment. But then they quickly start to get a little bit more granular and talk about, well, what are the risks and opportunities on these ESG issues that are specific to their own business? And really, where are we in terms of being able to look at some of these items with our own internal reporting capabilities? Some of that might relate to sustainability issues with the climate, whether there's measures on carbon impact. Other cases, it might be human capital measures. But what they're really doing is kind of assessing, are we ready to really measure this with the level of rigor that is needed for an incentive plan? Now, in terms of results and where we are right now, depending on how you measure it, there's between 1/3 and 1/2 of what I would say large companies do right now have ESG measures in their incentive payout determinations. Usually that tends to be in the annual bonus plan, not the long-term equity grants. And in terms of what it looks like, well, there might be environmental measures that you see in energy and mining sectors. There might be workforce measures related to human capital in some of the sectors I do a lot of work in, such as technology and life sciences. But really, at this point, it's usually very modest weighting in those incentive plans. The ESG measures might account for perhaps 5 to 10% of the bonus in a given year. And often it's not a case of straightforward goals. Often it's more of a case of there's a broader scorecard, and companies are sort of exercising discretion to say, by and large, are we making progress in these areas, as opposed to having very strict milestones, if that makes sense.
Well, it seems like, the reality is you can't stick everything that's measurable into the executive compensation plan. It would just,
Amen.
it would just get so unwieldy. So do you think people are going to use that as sort of a discretionary plus or minus, or how? I mean, maybe there's certain ones that can be plucked out, but with all the discussion today, there's no way that you can include all the things that are being discussed that they want measured. So what do you
No,
think?
no, I agree. And I think there is sort of a continuum in terms of how companies are implementing ESG measures into their incentive plans. Again, if we go back to that idea of looking at internal reporting capabilities and what companies' specific risks are in these areas, the ones who might be relatively low in terms of the risk to the enterprise relating to sustainability or relating to just some of the environmental issues, well, they're the ones that are most likely to really think of this as we have sort of a scorecard for individual performance on an executive by executive basis. And in a given year, that might bump up or down the bonus 5 to 10%. How that executive is supporting some internal initiatives, perhaps on human capital development, diversity and inclusiveness, safety items, that might just be part of the scorecard. Where you're a little further along on the continuum, and perhaps there's moderate risk related to some of these issues in your business, and you're feeling a little better about being able to measure them, at that point, you start to have a scorecard that's not specific to the individual, but it's more of a kind of a carve out at the corporate level for some of these items. And it's still probably a discretionary assessment, and you're starting to get closer to maybe 10% of the bonus. It's the companies that are, well, let's say, for example, companies in mining, companies in the energy sector. They're the ones that are most likely right now to have standalone quantitative goals that go across the executive team, that have clear threshold, target, even upside opportunities on these measures. And in those cases, you might get upwards of 20% of your bonus tied to this. I have a hard time imagining that there's any company that's, we'll always find one or two outliers, but I have a hard time imagining there's going to be a lot of companies that would put more than 20% weighting on these measures. I think at that point, you might actually start getting pushback from the investor community, especially if you ended up in a situation where you didn't meet your financials, but somehow you're still paying out bonus goals that related to, we did a fantastic job on our human capital initiatives. We did a fantastic job on safety, even if we weren't hitting our revenue and profit goals. I don't think that's the outcome you want. And getting back to another aspect of that question, TK, I think these companies over time are going to find that it works better if you sort of think of your ESG performance as something that serves as perhaps a modifier on your financial performance. Perhaps it's something that is able to bump up your score on the financial measures up or down 10%. What's nice about that is in the years where you're not delivering financial performance, it's not like an ESG number is going to be in makeup. And on the other hand, where you're really doing well and firing on all cylinders, income statement performance is great, the balance sheet looks good, investors are seeing healthy returns, there's an opportunity here for that ESG to perhaps uh, provide an additional bump, if that makes sense.
Yeah. So we have about a minute or two left, and I want you to, again, with all the interaction that you have with comp committees and looking into your crystal ball,
Yeah.
how do you see um, ESG and executive comp looking in the future, and what should companies be doing now sort of to stay ahead of the curve?
Oh man, the crystal ball is murkier and murkier in the executive pay. There's been so much noise in the ecosystem over the last year, but I do think that it's a case of anticipate increased prevalence rather than reduced prevalence. I think there's good news coming out from a number of groups that are going to provide for more agreement on sector-specific standards. Um, the Sustainability Accounting Standard Board, the Task Force on Climate-Related Financial Disclosures, the big four accounting firms right now, they have a big effort with the World Economic Forum, all that are getting to the idea of helping companies and investors understand what good looks like on some of these measures. That's going to roll into plans. What I'm telling clients is that they need to have a good handle on where they are on that readiness curve before they can really talk about implementing the plans. So there, I do think it's incumbent upon companies to be asking questions about what are we able to report on right now. If we're not seeing reports on things such as human capital and sustainability issues in the compensation committee, I think it's a reasonable request to management to start saying we need to see these numbers before we start hearing about investors on whether we're laggards on this or whether we're leaders on these dimensions.
Well, there's no question it's going to be an interesting year as stakeholders and ESG issues, particularly the social part of ESG,
Oh, right.
as those discussions ramp up in the boardroom. So good luck in your comp committees. And thanks, Jim, for taking the time to join us.
My pleasure, TK. It's always good to close one of these discussions with hearing good luck.
Yeah. Well, that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.